In the American markets, where trillion-dollar companies usually dictate the pace of innovation, there are still moments when a mid-cap operator does something so violently out of pattern that it forces every rational investor to stop and ask how this is even possible. The story of IREN is exactly that kind of rupture. Not a surprise, not a lucky break, but an outright statistical anomaly. A company that began in 2018 as a renewable-powered Bitcoin miner somehow emerged by late 2025 as the counterintuitive anchor of nearly $10 billion artificial intelligence cloud agreement with Microsoft. And it accomplished this during the tightest GPU shortage in modern computing history. For investors who understand how infrastructure procurement usually works, this was not only unexpected, but deeply disorienting. To appreciate the scale of the anomaly, we need to understand what normal looks like. A Bitcoin miner with modest power contracts usually expands slowly, megawatt by megawatt, transformer by transformer, hosting client by hosting client. Diversification into high-density artificial intelligence compute, especially liquid-cooled GPU clusters, normally requires many years of certifications, hyperscale-grade electrical engineering, redundant fiber routes, and an extensive operational track record. Hyperscalers like Microsoft, Amazon, and Google almost never outsource large AI workloads to companies that lack these credentials. They rely on operators with decades of data center experience, not firms still navigating litigation over earlier disclosures. IREN did not follow any of these norms. In November 2024, it rebranded from Iris Energy to IREN. A rename is not unusual, but using it as an entry point to a transformation of extraordinary magnitude is rare. At the same time that a class action lawsuit filed in 2024 claimed that IREN overstated the progress of its Childress, Texas site for investors buying between mid-2023 and mid-2024, the company accelerated construction at that same location. And while doing so, it quietly began high-end NVIDIA GPUs at a pace that defied even the most optimistic procurement models. By mid-2025, IREN held more than 23,000 GPUs, including Blackwell generation accelerators. Under normal industry practice, GPU allocation flows first to hyperscalers, then to large enterprise integrators, and only then to smaller operators who receive later and often partial shipments. IREN obtained hardware faster than operators with market caps in the hundreds of billions. This raises the first major question. How did a former Bitcoin miner bypass a deeply entrenched GPU allocation hierarchy? Investors have proposed multiple theories. Maybe IREN locked in volume contracts far earlier than expected. Maybe its unusually large and immediately available power capacity gave NVIDIA and Dell strong incentive to prioritize it. Or, in a theory that many investors whisper about, a hyperscaler may have already had visibility into IREN's capabilities long before the public learned anything. That would explain why the GPU flow followed none of the usual industry patterns. Then October 2025 made the story even stranger. IREN raised approximately $1.9 billion in back-to-back zero-coupon convertible notes. This type of financing is not common. Lenders accept no interest and only profit if the stock appreciates significantly, allowing conversion at higher values. Companies usually issue such instruments when they already have secured long-horizon revenue commitments. In normal sequencing, a company lands an anchor contract first and only then raises capital. IREN reversed this order. It completed a massive raise before announcing any major customer relationship. That implies that institutional participants may have already anticipated the coming transformation. Only a few weeks later, in November 2025, the transformation was revealed. IREN announced a 5-year artificial intelligence cloud contract with Microsoft worth roughly $9.7 billion. Around 20% of that value would be paid upfront. In standard hyperscale arrangements, payments are milestone-based and tied to commissioning stages and operational verification. Upfront payments shift risk to the buyer, and hyperscalers almost never structure deals this way with operators lacking extensive enterprise credentials. Yet, Microsoft did exactly that. The location of the deployment made the story even more extraordinary. Childress, Texas, the same site referenced in ongoing litigation. Under normal hyperscale diligence, a site with disputed disclosures would undergo years of scrutiny, including evaluation of redundancy schemes, thermal tolerances, grid reliability, fiber route quality, and operator history. Instead, Microsoft committed one of its largest GPU expansions to the site, And that commitment was matched by a $5.8 billion Dell Technologies hardware pipeline focused on liquid-cooled rack systems for clustered GPU workloads. Such a chain of events breaks multiple industry norms. It is not only unusual, it is deeply revealing. The most plausible inference is that something about IREN's power availability, construction velocity, or internal engineering capability gave Microsoft confidence that the site could be scaled at a speed the rest of the industry could not match. In a market gridlocked by transformer shortages, permitting delays, and land limitations, IREN may have held exactly the combination of assets the hyperscale world was starving for. The market reacted instantly. When the Microsoft deal became public, IREN shares jumped more than 20% in a single session. After climbing from around $5 to peaks near $77 earlier in the year, the stock moved as if repriced around an entirely different business identity. Investors no longer valued a Bitcoin miner. They valued an emerging AI infrastructure platform capable of delivering one of the largest outsourced GPU deployments in America. Still, contradictions remain. The litigation is ongoing. The construction risk at Childress is immense. Zero coupon convertibles imply future dilution, and everything now hinges on whether IREN can activate roughly 200 megawatts of liquid-cooled GPU capacity on schedule. If it does, its future valuation could align with analysts who forecast a range between $70 and $100 over 12 months. If it stumbles, shares could fall back into the 30s. The company's destiny depends on whether, starting in 2026, AI revenue overtakes Bitcoin mining and permanently redefines IREN's core identity. And this is where the story matters most. IREN exists in a paradox. A site once questioned is now the center of one of the largest artificial intelligence deployments in North America. A company once dismissed as a miner is now a potential gatekeeper of power-dense compute capacity. Whoever controls that capacity controls a foundational layer of the AI economy itself. By the way, since many of you listening follow emerging AI infrastructure names or early-stage compute operators or transformative high-growth stories like this one, the ValueStir channel is actively inviting your suggestions for both public and private or even pre-listing equity and coin assets that deserve a deep dive. So feel free to leave them in the comments. Your comments directly shape the next investigations and the next long-form mysteries we uncover. And to those who watch, subscribe, like, comment, and share these episodes, thank you. Your support pushes the channel forward and lets us build even better content for you. This was Value